There are 1.3 billion credit cards in use in the United States alone, and every single time one of them gets swiped, someone is making money. But here's the thing. It's not just when you pay interest. It's not just when you're late. It's every single transaction. You could be the most responsible credit card user on the planet. Pay it off every month, never miss a payment, and they're still making money off you. Today, we're going to break down exactly how. The fees you never see, the traps built into the system by design, and why this is completely legal. Let's start with the big picture. Americans' total credit card balance hit $1.277 trillion at the end of 2025. That's the highest number since the Federal Reserve began tracking this data in 1999. To put that in perspective, that's more than the GDP of most countries on Earth, just sitting on credit card balances, accumulating interest every single month. And who's on the other side of that number? Visa, MasterCard, Chase, Capital One, American Express. Companies that collectively made hundreds of billions of dollars last year, legally, from people like you and me. About 47% of American cardholders carry a balance month to month as of late 2025. That means nearly half of everyone with a credit card is paying interest right now. But wait, what about the other half? The people who pay it off every month? They think they're winning. And they're partially right, but they're still feeding the machine, just through a different door. There are actually 3 doors, 3 ways credit card companies extract money from every transaction. And most people only know about one of them. Door number 1, interest. This is the obvious one. Of the $130 billion that credit card users paid to credit card companies in 2022, over $105 billion came from interest payments alone. The average APR right now? Around 20%. 20%! In a world where your savings account gives you maybe 4 or 5%, if you're lucky. So every dollar you carry on a balance is essentially costing you 20 cents a year, just to borrow your own future money. But here's where it gets interesting. Door number 2. Fees. Annual fees. Late fees. Balance transfer fees, cash advance fees, foreign transaction fees. Card issuers collect multiple types of fees from cardholders: balance transfer fees, annual fees, cash advance fees, returned payment fees, and late fees. Most people know these exist, but they underestimate how much they add up across hundreds of millions of accounts. A $95 annual fee on a premium card times 10 million cardholders is nearly $1 billion just for holding the card before you spend a single cent. Door number 3, and this is the one almost nobody talks about. Interchange fees. Every time you swipe your card at a store, that store pays a fee. Interchange fees are paid by the merchant's bank to your credit card issuer, and they're set by the card networks: Visa, MasterCard, Amex, varying depending on the type of merchant, the type of card used, and other factors. Typically around 1.5% to 3.5% of the transaction. Think about that. You buy a $100 pair of sneakers. The store pays $2 or $3 to the credit card network just to accept your payment. Even if you pay off your credit card balances every month and never pay interest charges, credit card companies are still making money off you, because every time you use your card, the merchant pays a fee. And here's the twist. That fee, it doesn't disappear. The store just builds it into the price of everything they sell, so you're paying it anyway. You're just not seeing it on the bill. Now, let's talk about the most elegant trap in the history of consumer finance: the minimum payment. It sounds harmless. It even sounds helpful. Don't stress, just pay the minimum and you're fine. That's exactly what they want you to think. Here's how it actually works. Imagine you start with a $10,000 credit card balance at a 22% annual percentage rate. Your minimum payment is calculated as 2% of your balance, so in month 1, you pay $200. But in that same month, interest on your $10,000 balance is about $183, which means after your payment, Only about $17 actually went toward reducing your debt. $17 out of a $200 payment. $183 went straight back to the bank. And it gets worse over time, because as your balance slowly shrinks, your minimum payment shrinks too, which means even more of each payment goes to interest and less to the actual debt. The share of active accounts making only minimum payments hit a 12-year high in the fourth quarter of 2024. If you only make minimum payments at 19% APR, you could be in debt for 170 months. That's over 14 years. And pay $6,491 in interest on a balance you could have paid off much faster. About 3 in 5 cardholders with credit card balances have been in debt for at least a year, and 21% have been in debt for at least 5 years. 5 years, paying every month, and still in debt. Now, is the minimum payment illegal? No. Is it disclosed? Technically, yes. Since the Credit Card Act of 2009, card issuers are legally required to include a minimum payment warning on each billing statement, showing the total time to pay off the balance and the total amount you'll end up paying if you only make the minimum. Bloomberg, it's right there on your statement, in small print, that almost nobody reads. The trap is legal. The disclosure is there, and billions of people fall into it every year. Here's where it gets really clever. Cashback, points, miles, travel rewards. Credit card companies spent billions building reward programs, and the average person thinks they're beating the system by using them. I get 2% cashback on everything. I'm making money on my purchases. Are you, though? Let's think about where that cashback comes from. Remember those interchange fees the merchant pays every time you swipe? Premium rewards cards charge higher interchange fees than basic cards. So when you use your fancy travel card, the merchant pays more. The merchant raises prices to cover it. You pay slightly higher prices on everything, and then you get 1% or 2% back. You're essentially getting a partial rebate on a fee you were already paying invisibly. And that's assuming you're in the group that never carries a balance. More than 50% of cardholders carry debt from month to month. The rewards are completely wiped out by interest, often many times over. A 2% cashback card with a 22% APR is not a reward card. It's a debt trap with a shiny sticker on it. The math is brutal. If you carry a $5,000 balance for a year, you're paying roughly $1,100 in interest. Your 2% cash back on that same spending, assuming you spent $5,000, gives you $100 back. You're down $1,000, but you feel like you're winning because of the cashback notification. So why doesn't anyone stop this? The short answer, it's not illegal to charge high interest. It's not illegal to design a minimum payment system that keeps people in debt for decades. It's not illegal to bury the real cost of rewards in merchant fees. It's all disclosed. It's all in the contract you signed, usually in a document that runs 30 pages long in 8-point font that almost no one reads. And the industry has very good lawyers and very effective lobbying. 83% of Americans think the government should put a cap on credit card interest rates. That's a rare level of agreement on anything in this country. And yet, here we are, with average rates around 20%. No federal cap in sight. There have been proposals. The Credit Card Competition Act, interest rate cap bills. Most of them die in committee because the financial industry is one of the most powerful lobbying forces in Washington. And credit card revenue funds a large part of how major banks operate. This isn't a conspiracy. It's just how money and politics work. So, what do you do with all of this? First, understand that the credit card system is not designed to help you. It's designed to make money off your behavior. Sometimes that behavior is responsible. Sometimes it isn't. Either way, they win. Second, if you carry a balance, the minimum payment is your enemy. Pay as much above the minimum as you possibly can. Even an extra $50 a month makes a significant difference over time. Third, rewards are only free if you never carry a balance. If you do carry a balance, cut the rewards card and get the lowest APR card you can find. And fourth, the next time you swipe your card, remember, someone is getting paid. 3 someones, actually. the network, the issuer, and the acquiring bank. The credit card isn't a convenience tool with some fees attached. It's a financial product engineered by some of the most sophisticated companies on Earth. The least you can do is understand the game before you play it. If this video helped you see the system differently, subscribe because we're just getting started.